No, no, no. I mean, the bigger trades that I'll take are become, a lot of times the auto trade won't pick up a trade, because it's only looking for specific structures and so forth. So, for instance, right, as an example, right, so you got a trade here that we call a discount, right? So this one never triggered, and it's not the and even though it's a valid signal, the trigger never unfold, never happened, right? So that would be something that when I see a signal, okay, I'm gonna, I'm paying attention of whether or not the remainder of the price action, develops, right? That would be, again, it's still kind of following the protocol of the various signals. My preference is to take trades from specific, zonal locations, right? So like here on this, okay, against the A10, that's, that's a valid trade there. Whether you do it in an automated fashion or manually, yeah, I do take manual trades as well. All right, so like there would be a case here, like where the market's kind of held and it's starting to move higher, right in kind of this area here. Well, there's no automated trade for me there, right? But that is, what I'm seeing at this location and this kind of configuration right here where this star is. I'm kind of circling. The momentum is building, to further the upside. So this would be a trade where, although I didn't take it this morning because I'm talking, but this would be a trade here where I would, take a long, okay, and then try to, ride this move as, basically as far as it, can go. But that would be a non-automated trade, all right, that I would take. Or, one of the ones that very popular, right, would be, the look below, right, and fail, right? Look below, fail. Or, I call that a peekaboo, right? If anybody watched years ago the sitcom Home Improvement, all right, with Tim the Toolman Taylor, right? His neighbor, right, Mr. Wilson. If you ever watched that, he had his little eyes right above the fence, right? So I call that a peekaboo. So the idea is, yeah, it's kind of funny, but the idea is, like if it looked above this level and then came back, right, or looked below the key level and comes back. So this would be, once we get a pivot, and I'm always looking for a pivot, right? That's really what I'm looking for. I'm looking for a break. If it breaks below a level, I'm not just trying to buy a level necessarily, right? I mean, I could probe that, but I'm really looking for a pivot to reverse back. Once we get this, a look below, right? See if there's anybody home, see if there's any, momentum further to, in this case, the example, to the downside. And if it doesn't, and it starts pivoting back, then take a buy with a stop right below the pivot. All right. So then what we're looking for is the reversion back, towards the middle. Right. So that's a core play as well. Now that is not automated that we have, and that's, and that's a core play, I think, across the board for a lot of people. I know it is for you, Manny, and there's a lot of people out there the same thing. So here would be the example here. You get a look above the midpoint, okay, and then you got kind of this little area here where, essentially you got a pivot, right? So this would be an area if you wanted to short, right, for a play back down to kind of this middle zone here. So that would be what we would call a peekaboo, a PKB, right? So look above, fail, and again, they're not infallible, right? They're just simply a play where, market maybe has reached an extreme point and we're looking for a reversion. Now again, a lot of that has to be a lot of that is part of what type of rhythms are we getting. If we're getting kind of a bracketed range rhythm, they tend to work pretty well, right? The PKBs, right, or the look above, the look belows. If we're in a more trending kind of rhythm, no, less likely. So you don't have to use the same trades, and we don't in our playbook. We adjust to, we have these type of range rhythm plays, peekaboo type plays, looking for that, or It could be as simple as a value low. I know there's a lot of value players, right? Just a value low, right? So, and again, the key is this: what do you expect at a value low in a range like what we have today? What would you expect? I'm expecting buyers to be there, right? So the sellers push it down, right? I'm expecting buyers in and around that area. If they dip it below and come back, even better, right? Because always know where there's a previous pivot, right? A pivot low or pivot high. That's why we end up marking them off quite often, right? Is because what's below there. They're stops. What's above these highs. They're stops. All right, and essentially that's what the look above and below is all about. All right, is to grab the stops. So we used to do that when I was a market maker all the time. I mean, it's just part of what we did. Not that I cared about getting retail stops or anything. It wasn't really about that. It was just about clearing out liquidity, right? Finding where those pools of liquidity are located, and it's very easy to find them with stops. You know, you can essentially know where those stops are, and that's why, like I outline these lines here, right? So I don't have to. I only have a small segment of charts that I look at because I got limited space. But I've already done the work on putting that's a pivot level. So what's up here? Right, stops, right, in this area, right? There's definitely stops, particularly to the high, and of course there's even more stops right above the high. So, right, what do you think is more likely to happen here? They're going to try to jam those stops, right? Here's another thing that we look for, and again, we're talking here, so I'm not really in a trade at the moment. But again, once we identify kind of call it a support point, right, and then we see this kind of move here, and we're getting, and again, you can see how the moving averages have moved up. This little indicator here is called the bid-ask volume ratio. I know I know you like looking at order flow. This is order flow, okay, on a graphical basis. And again, I can put the delta footprint chart over here on the left, and I can see, what's happening bar by bar, price by price, right? So some people like, they're numbers guys, right? Numbers guys. So they like looking at the numbers within, price bars. That's fine. All right. I don't care necessarily. All right. But in the bid-ask volume ratio, it's showing you the same thing. So right in here, when it started, you see all the buyers, they're lifting the offering pretty aggressively. So again, this would be a play where, I'm staying with, the direction, okay, and that would be again a non-automated trade. That would be a play. And again, in the middle here, this would be something where we'd want to get to the pivot level here that's outlined, and then possibly even higher if they're going to go, grab the stops, right? So whether you're looking at order flow, if you like looking at, if you take a look at this order flow on the left, you can clearly see, there's really good buying there. Okay, so whether or not that's a trigger for you, to take a trade, to initiate a trade off of what's going on. Again, that's going to be predicated on your plan. All right. But we have all the tools there, I think, that that are useful, and nothing that we have is not useful. Yeah, I mean, I've gone, yeah. Yeah, I mean, Yeah, so what we have running here on our end is a momentum long, right? So again, this is somewhat of a shallow pullback. So we're playing the what we call an A4, an ATR4 is playing a momentum long. Again, this is momentum. You know, it's getting up near the highs. We're expecting for some further follow through. All right, here, and you know, again, we certainly want a deeper pullback possible. You know, for greater potential. But if the momentum here continues, this is grabbing a momentum long trade. See if that plays out for us. That's what I told choose. Also, one thing, when you need to be, obviously, I think everybody should be aware of if they're not. But when the volatility increases as it has, and these ranges are a lot wider, and even pullbacks. I mean, I know I heard you, Manny, yesterday with Bo saying, like, you're getting like these 20 handle pullbacks in a heartbeat. Well, you need to be, you need to adjust your, uh, if you have a certain dollar risk per trade, you have to obviously adjust your position size accordingly. And that may, like, typically we use like a 6 or a 7 point stop for the most part in normal kind of conditions. And that can be tightened too, depending on how you're entering your trade. But for the most part, we use the kind of 6, 7 point stops. When the volatility increases, as it has, you may need to widen that stop out, the initial stop out, or blend into a position rather than going all in, in one shot, right? So I like to blend into a position versus just all in. I think Bo is real good at that. He likes blending as well. But you still need to adjust your positions accordingly. And then once you're in whatever the size trade, you got to scale out of something to mitigate your risk. And then you can always kind of go back in, go back out, come back in, come back out. Not scalping per se, but just in terms of management of a position. Because if the market wants it, you're going to get this ebb and flow, up and down. So you need to have your stop. You don't want to get stopped out too prematurely, and that's always frustrating. And then so in order that, you need to make sure you have your stop, at the requisite location. So position sizing is really important. I know a lot of people just go, oh, just buy one here and buy one there and buy one. Again, you want to be efficient. Having planned out your trade, know what the history of that trade is, what your maximum adverse excursion is on those typical trades that you take, what's the favorable excursions, so you can then say, okay, if the maximum adverse or the average adverse is, say, 6 points, all right, well, then I want to be outside that noise, and I'll put my stop at 7 points, but that maybe require me from going from 3 contracts to 2 contracts or something like that to keep my dollar risk in line. So it's important that sometimes you may have to widen out your stop, in which case you got to reduce your position, and so forth. So all part of the process. I'm trying to look for, again, I was a little early on that automated trade over there. And we got stopped out a little bit quick on that. That was unfortunate because the momentum is intact. So we'll see if with this pullback pivot holds here into the, what is it, 86s? I can't read that. Yeah, about 86s or so. Yeah. Well, Manny, what do you do? Like the coaches, like so when you're playing the game, right? And what you're saying is just stay in the moment. Just the next play, the next play, the next play. So it'd be like us, the next trade, the next trade. And there's nothing to learn in real time, all right, on that play, whether it was a good play, whether it was a busted play, or trade, whatever. There's nothing to learn. And at that moment, what do? You watch the game films later, right? And then see where you can, what happened and where you can improve. So afterwards, you go, it'd be the same thing with trading, right? You can go back and say, okay, this is what I did. What did was it something that I missed in the read? Okay, etc. But again, and that's part of the process. So the same thing with game films. You watch the game films, not immediately after the game. You wait a day, like you let your emotions, settle down and so forth, and you go back, and then you kind of make whatever adjustments you need, that potentially need to make. Maybe there's no adjustments you need to make, and you just followed the plan, and it just it is what it is, winner or loser. But you did everything that you were supposed to do, according to your plan. There's nothing to learn from that, but except to say, hey, I followed my rules, I followed the plan, and that was it. Well, one thing about, go ahead. No, I was just going to say just in addition to that, one thing I found, everybody kind of wants to lean on. Psychology is important, no question, right? For trading, it's a huge part of it, but you can also kind of dampen the effects of the psychology part of it by planning. It's like what you do and I do and others, and researching, right? So, which trades am I researching? Know what the statistics of your trades are, right? Know what the history of those trades are, the repeatable trades, not just trades that, I think the market's going to go up, so I'm just going to go buy some, right? That, to me, that's wing dinging. That's a wing ding trade, just on a whim. Oh, it looks like the market's going to go up, I'm going to go buy them. Well, what research have you done to establish that, the success rate of that type of trade, right? A wing ding trade? Probably none, right? But in this, so what's going to happen in the case like that, when you're doing kind of what I refer to as a wing ding trade, is your emotions are going to be all over the place, right? Because you really haven't researched that trade. You're just taking it, on what you're seeing in the market at the moment. You say, but there's really no research that you've done on that. So what's going to happen is you're going to be a slave. You're really your emotions are going to go all over the place, and then you're just going to make crazy decisions, and and it's going to be that roller coaster ride. But if you've researched a particular setup that you see repeatedly and says, there's some viability there, and you go research it, a pullback, a discount, or what we call a discount or premium, etc. And you go back and say, well, how often does that occur? And you've done all the research, and you say, well, over the past, sample size of, say, 200 or 500 trades, these have been the results, the hard results. Well, when you start putting that in real time, yes, this trade is still potentially a 50-50, but the characteristics and the structure of the trade is similar to ones that have really good success rates in the past. So what is that going to do for you, right? Well, you're going to be dealing with a structural play that has some statistical, foundation to it. And when you do that, that's going to help your psychology, because you won't be all over the place when the market is moving around. You can say, yes, a loss is part of the performance, so I accept the fact that it'll lose. But at the same time, I'm taking a trade that has characteristics of successful trades, not just of the past one or two trades, of whatever the sample size, and again, the larger the sample size, the better. So 500 trades, the same trade over and over, the same structure. So then you have a foundation of what the historical performance has been, right? Doesn't mean this one's gonna happen exactly like that, but you have all the characteristics. And when you do that, you're depending upon hard research that you've done in the off hours, and probably arduous research in most cases. If you do it correctly, it takes a long time. And then when you're real time, like we are, and the market's moving wacky, like it does most days, you're grounded in, hey, I'm just following my trade plan, and I know what the history of that trade has been, and I'm going to just follow my rules. So you're not really subjected to, oh, it's a wing ding trade, and I think the market's going to go up, or I think it's going to go down. So, or this is what's happening, with the price action, because again, they being the algorithms, the market makers, whatever, they just want to draw you in and really kind of play on your emotions. But if you stay with a structural play and be patient, yeah, I think that that is a big way to combat emotions, psychology. Again, you still need to have your psychology, but it's the emotions that drive the decisions. Not we can all talk logically about psychology, but when we start talking about emotions, it's very emotional, and so that's really, at the end of the day, we call it psychology, trading psychology, but I refer to it as trading emotionology, which is really what you're trading. You're trading your emotions, and if you're not grounded in a structural pattern that you've researched, your emotions is going to drive you. That's going to be the driver, and you're going to be all over the place. So that's my story, and I'll stick with it. Yeah, well, that would be that 6904. I just marked it off here on my chart. That would be, there's your pivot there. So if it came down, that I'd be looking for that kind of peekaboo type trade, right? Because there's obviously some stops below that, and so that would be the play if it gets down there further. One note about what you're saying about you wanted to kind of protect your trades that you currently have. All right. I'll just add to that if that's part of your trade plan, right, and it all comes down to knowing what and you mentioned it about your own personal statistics about having X number of trades, and when you start over trading beyond that figure, then you get diminishing returns on your performance, right? So you need to know that about yourself, and then of course everybody's going to be different, right? But also one thing that and again, I kind of go back to, like, the market doesn't give two hoots about what you want to protect. Okay, it's just going to do, it's inanimate. It's going to do whatever it's going to do, whether you're there or not, right? So again, this all comes down to that psychology and the statistics about not only a trade, but your trading history, right? Your own personal trading history, and so forth. So but for the idea, I mean, you got to trade, you got to follow what is right for your plan. That's number one. But in terms of like, whether or not the next trade is going to work or not, the thing is this: if it's a valid trade according to your plan, okay, then and you have a little bit of cushion, again, whatever that cushion may be. But if you have some cushion in terms of what your P&L is for that day, all right, my view is, have an ultimate, final stop loss for yourself. In other words, let's just say, throw it out there, you're up a couple $1,000s for the day, right? And you typically risk, say, $500 or so, per trade, right? Max risk. Well, in effect, you have 4 trades, that you could theoretically take, and break even if they all lost, right? But what's the likelihood of all of them losing? Again, that goes back to kind of the statistics that I was talking about earlier. But you may say, hey, you know what? I'm up 2,000. The market's, rhythm is going pretty well. I'm in rhythm with the trades that I've taken. All right. I'm going to take this next trade if it's valid trade according to your plan. I'm going to take that next trade and I'm going to risk that $500, right? Because, then you can say, well, you know what? I'm up to, maybe I'll take the next 2 trades, valid trades. I'll take the new trades, and if they both lose, I'm going to walk away with $1,000, right? So you have your own stop loss in a sense, right? For your daily P&L, your ultimate, stop point. Okay. But what happens if those trades work, right? So, what I think is you don't want to, at least in my view anyways, you don't want to necessarily disadvantage yourself by not taking the next valid trade according to your plan, right? That has been working out fairly well. You want to, kind of, when the days are going well, in one sense, you really want to push in a sense, to try to expand, a good day into even a better day, but also, protect yourself from the standpoint of, well, if it goes against me, I have a stop loss and I'm going to stop, I'm going to stop at that point. I'm going to walk away with, a certain amount, whatever that is. And, you don't want to go negative, because then that will just hurt your psychology, right? Trading psychology. But you always want to, you get a good positive green day. I'm going to go home green at the end of the day, but I'm also not just going to be stopping because I'm fearful of that. I don't want to give what I currently have back, right? I mean, when you start the day, right, you're effectively starting with nothing. So you're willing to give X amount, your daily loss limit, away, aren't you? I mean, you are willing to do that. It's just funny how when you get into a profitable position where, like, oh, I don't want to give any of that back, right? It's all kind of the psychology part of it. So I view it as, well, if I'm up, whatever that is, I'm going to set myself a maximum stop loss that is still in the green, but I'm going to take the next, valid, trade setup according to my plan. So that's how I have reconciled something like that, when that occurs. And you got to be willing to, a friend of mine years ago, I keep remembering this sometimes when he says, you got to break a few eggs to make an omelet, right? So, in other words, you got to be willing to take some losses and take some hits, but again, not enough where it's, damaging you naturally, right? But, and again, we're always in protection mode when we're up, but when we're not up, I start the day with a 0 slate every day, right? I mean, regardless of what happened the day before, it's like we were talking about. I just forget about the day before and it's a new day, right? It's like you say it every morning. It's a fresh start every day. So start from 0. So if you're starting from 0, well, you already have allowed a daily loss limit for yourself. I'm not going to lose more than $1,000 or $2,000 or whatever it is. And if I do, I'm done. Stopping for the day, taking a walk, right? Well, you're willing to do that, but if you're up 2,000, now you're not willing to give that back. That's a question, and it's a psychology thing, right? So what's the plan for that? Well, again, my plan would be, well, I'll give back 1,000 of it, to play again, it's always about playing the proper setups. But I'm not going to give, I'm going to walk away green, and that's, that's kind of the way I look at that. Everybody's different, but you know, but how about, if the rhythms are real good and you're up a couple thousand, all of a sudden you can now you're up 3,000. All right, so you're up 3,000. I'm willing to give back 1,000. Right, so my stop loss just moved, just like you would in a trade, right? What do? You have a stop trail. So have a stop trail for yourself. I don't know, a lot of people don't think about that. I'm going to have a stop trail for my own P&L for the day. And hey, I just made another $500. Okay, my stop trail just moved up by $500. Right? So where I was going to stop earlier, well, now I can continue to go. Now my stop loss has moved to where I was willing to just stop for the day. Well, if I get back to that level, okay, I'll stop for the day. But why don't I just keep going, until I get stopped out, So something to think about for everybody. I think also one, can you hear me now? Can you still hear me? Oh, okay, good. I just want to make sure. Also, I think one of the, uh, I think skill sets or competencies for intraday traders particularly is the ability to shift gears, right? And because we can get ourselves very easily, they call them perma bulls or perma bears, and you can get yourself, in a situation where, your analysis, you want to be correct on your analysis and so forth, but you're unwilling to, deviate from your analysis, right? And so, um, you know, and the thing about it is when you get stuck in that mode, you're not, you're rigid, you're too rigid, all right, and you're just not flexible enough to go, to kind of go with the flow. I have a friend of mine, just a little while we're waiting for the next setup here. I have a friend of mine years ago. He's still a friend, but I mean, I haven't spoken to him in a while. But anyways, he when I was trying to make the transition from market maker, right, working for the investment banks, to an independent trader as I am today, it was difficult, extremely difficult for me, because though I was, a market maker years back, I was your ultimate day trader going back and forth. All right. I was always going against, kind of the directional move, because just the function of what I was doing as a liquidity provider, rather than today we're a liquidity taker, right? We're trying to, go stay with the flow. Well, anyways, short of the long story, he said, why don't you just be a jellyfish? And I took it, I took that to mean spineless. and I took kind of an offense about it. And he says, no. He says, you're misreading me. Don't take offense. He says, what do jellyfish do? And and I didn't really have an answer at the time, but he says, well, they just go with the flow. Right? They, the current of the water, the current of the ocean, they just go with the flow, right? They're not going in any direction necessarily. I mean, they have kind of, their way is moving through the water, but they're not really going against the current. He says, what you're doing is, in the early days after I left, the market making arena, he says, you're still trading like you're a market maker. You're fading the moves all the time, and he says, do you have the money to do that? And I said, well, quite no. And he says, you can't make yourself right. He says, and you're gonna blow yourself up, real quick. He says, the best thing to do is just kind of go with the flow, right? Just adjust with whatever the current of the market is, and he says, and just, he says, yeah, you're gonna miss trades, breakout moves and so forth, but if you're with the main current, the flow, he says, there's gonna be plenty of opportunities for you to get in on the flow. And he says, and it's not a matter of the price. The price is irrelevant, right? It's the structure and the direction of the price. And so, I kind of, took that, and over the years, and I've really, it's become, that's why I said, the main premise of what we do, in our world here, is the primary directive is to always stay in alignment. I just call it alignment, with the dominant force. So it's like, just go with the flow. In other words, if you like that phrase, go with the flow, be a jellyfish. Actually his company, his LLC that he created for himself, I think it's called Jellyfish something or other, right? But it has jellyfish name in it, and it kind of stuck with me. And I'm saying, yeah, it's just, I was always, the ultimate fade trader, and it's like, that's just not work. Does not work, particularly even then, but even more so today, and with the way the algorithms run, and just trying to fade a level. I'm just going to buy this level. Yeah, I mean, buying levels are fine. I mean, again, structural levels, there's nothing necessarily wrong with it. And again, you got to know your statistics, right? So, I mean, not every, trade in all cases are going to work out naturally, but But my premise is just to stay with the flow. And yeah, I'll miss a trade here. I'll miss some trades. No big deal. If you're trying to get every single trade out of it, you're trying to squeeze everything out of the orange or whatever, the lemon, the lime, whatever it is. You're trying to squeeze everything out of it. You're disadvantaging yourself. You just go with the flow. I don't care if I miss a trade. It just doesn't bother me. Because there's going to be another one. It's a never-ending flow, a river flow. But just stay in alignment with the river. And again, think about paddling. You're in the Niagara Falls River, okay? And so I mean, that flow is going to take you over the falls, but you got to work awfully hard to counter that flow, right? Not that you want to go over the falls, now, mind you, but the strength of the river flow, you're going against that. You got to have some strong engines to move that boat against that current, right? So why do that? I might as well just be in a canoe, stick my paddle in as a rudder, and just let the river take me. It's a lot less effort, and you go a lot further. So kind of like being a jellyfish, not spineless, just just go with the flow on it. So I don't know. It's just a mindset. That's all. It's just a mindset. I have. Will continue to, so long as So if again, it's all going to come down to how much you've done research on that particular trade structure. Okay, and if it's uh, sometimes the noise can just knock you out, right? And depending upon the noise of that day, and again that a lot of it's going to be based upon that particular kind of unique time, right? But again, if you've taken all the, time to do the research and you said, this has all the criteria and qualities, of good trades that have been successful in the past, then, you could get stopped out on a trade, like one of the other trades we saw earlier, it was unfortunate it got stopped out, right? It just overshot a little bit that particular stop point, right? If the structure, my question, my thing is, if the structure and everything is still intact, again, it's to your point about, you got to let that one go and say, re-ask the same question. Is the structure still intact? Would you take this trade again had you not taken that previous trade that you got stopped out on, right? And so you go back and say, well, is this still a valid structure? If I did not take that trade, would I take it now? So that means that you have to let go that other trade. You're not letting go that trade. You're incorporating that. You're saying, well, I took one stop out. Now I'm going to take another stop out. Well, again, what are your statistics about that particular trade? How many, ask, here's the thing. This is where a lot of people just don't want to do this work, is that, well, how often do like double stop outs happen? Like, I took the trade, I get stopped out. I took it again, it got stopped out. Like, what's the frequency of that? Right? My guess, it's probably rather infrequent, right? To the point where it's tough to find one or a sequence of them, right? But the question becomes, okay, it's got to stop out. Has the structure broken? Has the structure invalidated, or did it just kind of shake out because of the current rhythm of the market at that moment, right? Where maybe in other similar situations, the rhythm would have been different and you wouldn't have gotten knocked out, right? So then the question becomes, is that structure still intact? And if the had I not taken that trade, would I take that now? And if the answer is yes, essentially you're taking the second trade, to your point, to your question. But it's really though it's the second trade, you're worried about getting stopped out, all right? Again, because why? Because you feel as though you're wrong on the trade, right? Because, oh, I took it and didn't work. Oh, I must be wrong, right? Rather than it just didn't play out because whatever, it got shook out. You got shaken out. There you go. Get shaken out. And would I take that trade again? And so if the answer becomes yes, right, and the structure is intact and so forth, the decision as hard as it is, the decision is, yeah, I got to take that trade again. All right, because I mean, yes, there could be two losses side by side, and this is the thing. That's the psychology. If you get two losses side by side, right, sequentially, or maybe three losses, it's going to be tough to take that next trade, right? Mentally, because you don't want to, shit, I got 2 stops in a row, 3 stops in a row. Like, maybe it's me, or maybe it's just the market. Again, you have to go back to the step, that first step. Is it a valid trade? Does it meet the criteria? Had I not taken that trade, would I take that trade now? And I think that needs to be the sequence of your decision process. And that's what it is. It's the decision process that you got to have because again, this is all comes down to, knowing exactly what the type of trades are in the history of them. And, and again, this is where you can get caught up in that emotional, kind of negative feedback loop, where a lot of people can, have trouble with, right? So I don't know, that would be my response is it still valid, and would I take it again had I not gotten stopped out on that first one, Yeah, it's not the easiest thing in the world, and we all deal with it, because we all, internally we want to be right, and we want our trades to always work out, but really, I mean, that's just not going to be the case, and I have my method that I adopted from a fighter pilot called the OODA loop or OODA loop, depending on how you want to pronounce OODA, right? That stands for observation, orientation, decision, action, and you probably have heard about that, Manny, right? It's Colonel John, yeah, Colonel John Boyd, right? So he was a Navy pilot. Was a Navy pilot? No, I think it was. I don't know. I'm not. Yeah, either Navy or Air Force. I don't know. It's one of those, but not Marine. But in any event, his nickname was 42nd Boyd, and it wasn't what you would think. Right. But really, what it all came down to is back in the day, and this was in the '60s. Back in the day, at the Naval Air Station, the Top Gun. Yeah, I guess it was a Naval Air Station. So the Top Gun fighters. Anyways, he challenged the best pilots of the day. He challenged this was his challenge, from a position of disadvantage, meaning he's the defender. Okay, so he's the defender. From a position of disadvantage, he would gain the advantage in a dogfight. He would gain the advantage over his aggressor within 40 seconds and shoot him down. And of course, you can imagine the testosterone that was going on in the briefing room, at that point, right? So there was probably $100 bills flying all over the place, taking that bet, right? And not only that, story goes, and you can Google this, right? But story goes is that he actually had an inferior or slower airplane versus the aggressor. So kind of think about, like, a guy had an F-16 and he had like a Cessna, something like that, right? Whatever. And so so dogfight went on, and so and sure enough, and this wasn't just a one-off. He challenged. I mean, he did this time and time and time again. Well, from a position of disadvantage, he gained the advantage and he shot them down within 40 seconds. So his nickname became 42nd Boyd. And the takeaway on that was, his OODA loop, or his observation, orientation, decision, action. Now, again, aircraft physics are what they are. There's limitations, for all aircraft, regardless. But if you have a fly-by-wire, F-16, and you got a steam gauge, cable-driven aircraft, right? You're going to be a lot slower, right, and less maneuverable. Well, how could he gain the advantage, right? And they all knew the same tactics, right? Dogfighting tactics. But what the difference was, his observation orientation, his OODA loop. Kind of think of it as I do describe it as a bicycle wheel, right? So you got a bicycle wheel spinning, at a certain RPM, right? And then that's the observation orientation. So kind of apply this to the market where you're sitting and observing the market, right? Slow. And then as your structure's getting, closer into the development, right? So now you're going to enter this decision action cycle, right? You're still observation and observing and orientating yourself, right, to what, long, market's going up, right? A long lean. Okay, so observation, orientation. Now you're waiting for that structure to develop, maybe into a particular area level that you want to look and take the trade. And now you're into this decision action cycle. So what happens to that bicycle wheel in your brain? It starts speeding up, right? Because now, it's revving up, because now you're gearing up to take that trade. Well, in the dogfight with Colonel Boyd, his decision action, his OODA loop, right, was like multi times faster than his opponent that was trying to shoot him, right? He was, jinking back and forth his aircraft and all what they do with the dogfights, but he learned to anticipate what the aggressor was going to do, and he made the move to counter that even before he did it. So ultimately, within 40, I mean, that's 40 seconds is a short period of time when you're doing, maybe it seemed like a long time up there, but that's pretty fast within, but literally that's we got his nickname 40-second void. So the idea then is I adopted that decision model, and again, it's all on my website. It's all full details of how it's laid out, and so like right now, there's no trade, right? So we're in this observation orientation mode. Yeah, you see the trend up, you see higher highs, higher lows, all that stuff, and you're absorbing all that, but you're doing it at a very relaxed, pace, right? So your bicycle wheel, is kind of spinning relatively slow because you're not really ready to take a trade. But as it gets, more and more developed to your trade potential, your OODA loop should speed up. Like, this is what I'm going to do. You already know what you're going to do. This is how I'm going to enter. This is where my stop's going to be, my target, et cetera, et cetera. All that should be already laid out in advance, right? So when the market's, is really, really fast and moves, like right now it's kind of slow, right? But we know that it moves lightning fast. You can't be drawn into that, all right? That movement. Right, you have to control your own internal OODA loop in a sense, right? You got to be, that's what you can control, because you can't control what's going on the screen, only in your response and actions to what's happening. So you have to control that, and you can learn. Again, for the folks that are out there are interested, go, just Google OODA loop, OODA loop, and Colonel John Boyd, and there's tons and tons of articles on it. And even in some of the management, C-suites, they have, they've adopted, that kind of thought process, decision model technique. Well, I did it. I've adopted to our trading, and that's what I look. That's how I make, my decision. Like, so you were saying something to the effect where like, the longs aren't working. Okay, I'm going to take a short. Well, before I ever take a short, it's like, well, has structure broken? Right? Where would structure break? Or is it just a pullback within the context of a bullish structure? I mean, you could, or has structure truly broken, and we're going to, the odds now begin to favor a deeper reversal. All right. So, we don't know that, right? That's going to happen, but we can see that if it's going to develop that way, we can be along, we can see that it is developing. Again, that's that observation orientation, not guessing. We're not trying to predict, because when you do that, you're dead. But it's just, and that's the whole point about, like, go with the flow, stay in alignment. The OODA loop that we use here for decision model is, I don't see anything like right at the moment. Yeah, we're up at the highs, okay, and it's like what you said earlier, Manny. Well, there's acceptance up here. Okay, so that counts for something, I mean, yeah, they're exchanging handshakes here. There's volume going on, but right now there's not enough where the buyers are disinterested, and it's going to reverse. Could that unfold later? Sure, but it's not happening now. I don't see any evidence of it. So why would I be thinking short at the moment? I may not be aggressive long yet, still. Maybe I want to see some more development before I start, my OODA loop speeds up and I start looking for a trade opportunity. But right now, there's no reason to be thinking short. Yes, we're at some levels, we're at some targets. You can look on our charts here. We're at the upper edge of the money box zone, right? We're at the possible, we're at the 69.22s, which is a cycle day 2 range high. It says on our screen here, possible high, 69.2198. So 69.22, price is there. So price has met a cycle day 2 based upon cycle ranges, cycle day 2 objective. Just because it's fulfilled an objective doesn't mean it's a reversal. All right, it's met an upside. I mean, think about it, right? They met a range objective, but they could expand that range even further, to beyond that. So, until there's some sort of structural reversal signals that would unfold, there's no reason to think that the market's going to reverse, right? They moved it up here for a reason. The buyers are still aggressive. Call it what you want, shorts being squeezed or whatever. It doesn't matter to me, right? It's always nice to say, oh, it was the big squeeze. Could be, probably part of it, but does it really matter? Right? How it unfolded or who's on the wrong side? The fact is the buyers are dominant. Regardless of whether they're short covering buyers or, add-on buyers, it doesn't to me, that's an irrelevant piece of information. Yeah, to me, it's just irrelevant, right? Because that's not part of, that's where you start forming these opinions that get you into trouble. Okay? It's like, oh yeah, those are the short covers and whatnot. Well, who cares? Right? As long as you're not short, Yeah, right. Then that's another thing. So you will never, folks here in our community, they already know this, but you will never hear me talk macro stuff as it relates to trying to make a decision. I mean, I may speak of something about macro occasionally, but you're really never going to hear me talk about macro stuff when it comes to intraday trading. You won't. It's irrelevant to me. I don't care. It's not part of my OODA loop, right? Decision model. To help me make a decision, right? So there's a lot. I mean, I pay attention to all that stuff, but it's not factoring into how I make a decision. Particularly intraday. Yeah, I just for those interested, I just posted the link to the one of our original videos, educational videos, probability thinking, but techniques in probability thinking, and so take a look at that. Within that educational video explains the OODA loop action. In action, so some examples in there too. So that may help. You guys a little bit. Let me know if there's any questions by anybody who's interested. We're just jibber jabbering here, so not much further to do at the moment. Still long of crude oil on the opening. The other two. ES actually, I'm going to move my stop up on that. Managing the ES opening, got a stop trail there. NASDAQ, the NQ got hit all targets, and we have a stop trail in place on the crude oil. So those are good. Interesting. I need a new router then. I don't know what's going on. Crazy. Yeah. Could be scalping them to death. No, so like here, the new sandbox that I would outline, would be this kind of cluster in here that we have, right? So above the, would you say 04s before? So that, yeah, so 04 is still kind of remaining, pivot support, right? Which is the low end. So if this kind of rotated down into this area, could somebody play a short on a break of these little lows here? Perhaps, it depends, again, if that's part of your trade plan, right? I mean, it's like, hey, if they're breaking these little lows, okay, I'm going to go short them with a tight stop. Is that okay? I have no problem with that, right? Absolutely no problem with that, right? If that's what you do, right? So, and that's another thing. I will never, because there's so many ways of doing things and kind of, making profits and again, I don't mind, shorting a few contracts and making 3 points on it. I mean, that's it. I'm not trying to hit the cover off the ball on every trade, and again, all this stuff, yeah, I mean, and again, a lot of times it's just small trades that add up, 1 or 2 contracts here, 1 or 2 contracts there. You don't need to trade a bunch of contracts all the time. It's just not necessary. Not in our world. But you just got to be careful, because you got to be thinking about, it's like, well, so like just looking at this action right here, well, there's a pivot right there at around 14s, right? This pivot over here, right? Well, what do you think's going to be there, right? It's just going to break. I mean, if it breaks down really hard, really fast, it's aggressive seller, okay, it's going to break through. But if it doesn't, if it's just kind of, drifting down into that area, you're going to get some buyers that are standing around there. Again, it could be shorts, could be shorts from up above here. These higher, maybe somebody's short from there and they're looking, hey, I'm going to buy some on that lower pivot. Again, it's up to you how. Like I said, I have no problem with any of that. And see, yeah. And see, the thing is, we are all, as humans, we're always looking for a reason as to why something is unfolding. We're trying to rationalize sometimes the irrational. And you could find a chart, like I'm just moving on around my charts here, right? So, this is my multi-time frame chart that I have, workspace, where, I go from, quarterly, monthly, weekly, daily, 240, 60, 5 minute, all the way down to order flow, right? So this is about as, so you look at this. So this is, I'm just looking at a daily right now, right? So, again, the daily, right? We got this big, kind of range play here, right? Well, one could say, well, we're about halfway within that range, from high low, right? Approximately, right where price is right now. Oh, that's the reason why we're not going, anywhere. We're stalling at the, various moving, or we're stalling at the 50%. Okay, if you want to rationalize that to that degree, again, I'm not going to take issue with it, because I don't know what the reason is, right? I mean, it's funny because, you'll like, like you hear on at the end, evening news, right? Market was up, market was down, and they try to give a reason why. And like my wife would say, "Is that the reason?" I said, "No." I mean, so we're always trying to rationalize something that's really not able to rationalize, because there's so many variables that would go into the whole, composite reason of why the market is either going up or going down. And again, it may sound, juvenile, but the phrase, there's more buyers than sellers, or there's more sellers than buyers. Yeah, I mean, it sounds so juvenile, it's like, the obvious, right? Occam's razor, I mean, I'm a big Occam's razor, the simplest, solution, the simplest reason, is typically the more accurate one. But simply, yeah, this demand over dominated supply, or vice versa. Okay, I mean, you want to add more, color to that, in terms of, your rational reason of why the market is doing what it's doing. But fine, if that's what floats your boat, as they say, but I don't do that. Because it's such inaccurate information, and incomplete information, not something necessarily inaccurate, incomplete information. Well, why do you want to settle on that? Oh, it's the geopolitical problems, or it's this, or it's that. Right? Well, how about maybe it's zero DTE options buyers that are ripping it higher? I mean, oh, okay, I guess the evening news is not going to highlight the zero DTE options, gamma squeeze, right? I mean, that would kind of, like, their audience would go, there's no excitement. There's no excitement to that. There's no excitement to that. So, the point is, there's so many different reasons of any of this stuff. I don't even try to rationalize what the reasons. The buyers break above a level, and there's the buyers. I don't care why the buyers are doing it, or why the sellers are doing it. They're doing it. So it's either you try to rationalize it and don't do anything, and make yourself sound like you're smarter than the average bear, but ultimately it doesn't really matter. That's what I've learned. I hear you. I hear you. Yeah. 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 I mean, that. Yeah. No, that's there to sell subscriptions and stuff. I mean, okay. Whatever. There's just tons and tons of gullible people. And but that's what people, they're always looking for a reason. So, there's always somebody out there willing to give a reason. But at the end of the day, ultimately reasons don't matter. It's whether or not you walked away green or red. That's all that matters. Your bank account your trading account doesn't care about the reasons. You know, uh, you know, and and at the end of the day, a week later, you're not going to even remember the reason. So why even? And so these are just my viewpoints, and maybe I'm dry. Maybe it's just my call it old age in the business, since I've been doing this for 42 years now. 42 years now, or you can call it wisdom, or you can call it an insaneness. I don't know, whatever you want to call it, but it's just I don't allow myself to get caught up in reasons that are just they're just too numerous, and there's it's like they say, opinions, right? Everybody has one, and okay, that's your opinion of the reason. I'm not going to argue with that, and that's your opinion, because it could be that, could be something else, could be a composite of everything. More likely it's a composite of a lot of different things, because you get so many different angles. People are doing this, people are doing that, they're repositioning. I do like watching. I know you talked a lot about it the other morning, about the market internals. Okay, because that's giving you an objective view of what is happening, and again, not the reason of why it's happening, right? If you're looking for a reason, you're never going to find one. That's why I always said, everybody in our community, never ask the question why or will. Start like, why did that happen? I have no idea. Or will this happen? I have no idea. So don't even ask questions, beginning with why or will, because it'll just lead you to nowhere. All right. But if you say how, what, where, or if then, that will lead you, in a direction, where you can explore further, right? But reasons, it's irrelevant. So, anyways, that's again more thought. Yeah, I pay attention to a lot of that stuff as well. So that kind of goes into, whether whether you're trading options or not, you should be following the aggregate stuff that these services are providing, be it Stop Spot Gamma or the others, right? I use Spot Gamma, but it's knowing where these gamma levels are on those inflection points, right? Um, Again, to me, that's part of like this observation orientation, or the collective nature of the context, right? And so I'm not necessarily making a decision on what they're doing, individually, because again, what they do is that they're managing whoever's involved there. They're managing their book, right? They're managing their positions. They're managing whatever they're managing, right? So how they're doing, what they're doing, and why they're doing whatever is up to them. But the collective nature of a zonal area, right? That the market will kind of tend to gravitate to, right? We should have some idea of where those areas are likely to, where price, if again, the idea is if the market starts moving in that direction, right, what would be the most likely areas, the kind of the gravitational pull, right, to those areas. So having services like that kind of gives us that broader context, right? Monitoring the internals, right? So whether again, all the services various have them, but like the one I'm showing right here, this is Sierra Chart's internal version of internals, right? So this is the advanced decline ratio up on top here on the left, right? And these are ticks, okay? And this is cumulative ticks, all right? So the way I have it set up. So these are ticks and cumulative ticks, okay? So, you know, so like, and again, this is this is today right here. This at 218. So this is today on the advanced decliners. But you can see, I mean, early on, right? You could see the advanced decliners started, even during like the opening, excuse me, rotation, where the market just didn't rip higher right away. It just kind of chopped around a little bit before it found its direction. But you could see that on the opening, the advanced decliners started moving higher. All right. So again, that could be part of that ODA loop, right? Observation orientation. Hey, the internals are showing, early strength, even though the market's kind of going sideways early on, right? And then the same thing, you could start drilling it down into like, right in here, all right, on the ticks. Look at the ticks right from kind of the get-go this morning, right? I mean, they were pretty strong out of the gate, even though the market didn't, take off right away, right? But you could see the underneath, during that, the VIX expiration period. I mean, they was buying, pretty heavily there, right? Now you can see the cumulative excuse me, cumulative effect of it down below. But again, this could be something where like early on you could see that, hey, now typically a lot of people wait for the first 30 minutes or hour before they kind of get the that kind of rhythm, who's leading, who's lagging type of idea. But you can, right out of the gate, you can see the pressure of the ticks was pretty strong, right? This is on a 1 minute basis too. So, and this is a 5 minute up top, but this is a 1 minute here. So, it's pretty granular. And again, that could give you like during your opening range, right? We use a 5 minute opening range. So during the 5 minute opening range, you could see that, on our opening range chart there, you could see that the market obviously, went higher with the targets, entry and targets. But during that initial opening range, before it broke above the high of the 5 minute opening, you could be looking at the 1 minute ticks in here and saying, boy, those ticks are pretty darn strong underneath the surface, right? So now you can start figuring, you can say, well, how am I handicapping a breakout to the upside or to the downside? What would I be favoring? That could be part of that observation orientation ODA loop. That's a tool to use to kind of, again, not predict, but set a bias and say, hey, the pressure appears here factually, right? This is not, you can choose to, deny what you're seeing on the screen, right? Cognitive dissonance. But if you say, hey, I trust what's on the screen and the ticks are strong, what would that translate into? The potential, what would it translate into? Probably higher prices, I would assume, unless something else happens that it negates that. But I don't know if something's going to happen to negate it, right? So this is the whole idea about, when you're looking at information, is it the information that is providing you accurate, you know, metrics to make a decision, yes or no, right? If you're just full of cognitive dissonance, no matter what you're shown, you're going to say, I don't believe it. I don't believe it. Right? Okay, don't believe it. Right? But whether you believe it or not, that's where does that non-belief lie? In the marketplace? No, it belongs in your head. Right? So, you know, see, this is the whole idea. It's like you have to choose what tools you're going to use. All right? And then use them effectively. Know how to read them. Like, again, since I'm a pilot, instrument rated pilot, right? Again, you're in the clouds. You got to trust your instruments. I cannot have cognitive dissonance, you know, looking at those instruments. Okay, assuming they're working properly. If there's a malfunction, there's this, you have to figure that one out too. But again, we're not going to go to that point. But if it's all working properly, I have to trust that those instruments are accurate, and that they're going, proper reading of them is going to keep me safe, and particularly when I can't see out the window. All right, and especially I'm coming down on an instrument approach, right? Headings, altitude, I got to be spot on all those. I cannot have cognitive dissonance. I can't say I don't trust these instruments. Then what are you going to use? Seat of your pants? In the clouds? You're dead if you do that, right? Well, again, I kind of push that over to trading. It's like, if you're using ticks, you may not use it, or you may not use advanced decline or whatever. But if you do use them, like, whatever you use, you got to learn what they show you, right? The accuracy of them, right? And again, you can choose to trust them or not. But when you finally settle in on the tools that you're going to use, you got to use them effectively. You can't just keep denying that they're showing you what they're showing you. You got to trust them, and then you got to go with them, because otherwise you're just again, I look at it this way. Pilots use their instruments that have been tested over and over, tested over and over for accuracy. They clearly use those successfully, right? So I say, well, whatever instruments you're going to use here, i.e. tools, right? You got to know what they do, what they're doing for you, what they're showing, what they're measuring. And then if you are using whatever they are, ticks, advanced decline, whatever, right? Then you got to then move into the next stage, and I'm going to trust those with my life, but not really with your life, but with your trading account. You got to trust them. You got to trust them. And Yeah, it's just another tool, in the toolbox, really, what it all comes down to. And, it's just whatever can help you make, your decision to move you along, your path, your trading path. That's it. I mean, not one's necessarily better than the other. It's just how you use them. You can put the same, you can put the same tool, in a carpenter's hand, or let's put it this way. You could, let me do, the analogy would be this. You could put a paintbrush, like an artist's paintbrush, same paintbrush in two people, two people's hands, right? And say, okay, paint me something. Obviously it's going to be markedly different, right? And so, it's the talent and how you use, the tools that you have. A paintbrush is a paintbrush, but it's in the hands of the person that's doing the painting. That the painting, the picture comes out, and so forth. So same thing with trading. We all have access to the same tools, right? Really, I mean, for the most part. I mean, again, paying for various services, but for the most part, the basic stuff we all have access to. And it's, so why is somebody more successful using this tool, the same tool, right, versus somebody else, right? Isn't it the same tool? Yeah, but it's how they use it, it's how they interpret it. So, and because if it was all the same, the way that everybody was using it all the same, then I don't know, we probably wouldn't have a market. you know yeah, right. But somebody would be poor. Somebody would have to be poor. But that's the thing. It's what you use, how you use it. That really is the effect. I mean, it's nothing. There's not anything that, having been in this business 42 plus years, and I've used a lot of different things over the years, learned a lot of different ways, as market maker and working for a couple of hedge funds and so forth. That really, at the end of the day, there's not anything super unique. And people may think that there's, everybody has the magic wand, magic, there really isn't. Yeah, they could have faster technology, faster, communications, etc. Beyond what we perhaps all have here. But I'm not trading on that granular level where I'm competing again, in the nanoseconds, world, right? So if I were to do that, then I would need to invest, in the proper tools to compete in that level. We're not, we don't need to, right? And we can maneuver a lot faster than big institutions, right? So, I mean, if you don't think you're trying to outwit these institutional players and so forth, I mean, just make no mistake, you're not. You're not going to. But you can go along with them, right? Let them do the heavy lifting. I don't need to do that. I don't have, years ago when I was at, as a market maker, I had a $50 million credit line, right, to work with. But that was for pure bona fide market making. All right. So, I could take deep positions, without, management coming over and saying, why are you long 300,000 of that, type of thing. I mean, it was just the way, it was a different world, right? And again, in normal trading, I could be buying them down. All of a sudden, sellers are done, everybody's short, and then I'm pushing them back up, and then I'm selling them out, at higher prices. So I can make myself right, because I had the pocketbook in order to do that, as a market maker. And that's the same with these, these guys today as market makers, right? I mean, they push things around because, it's not that they're trying to get the small guy. That when I honestly, being firsthand experience, when I was a market maker, I did not think about the retail person out there trading. Didn't even think, well, it doesn't. That's all where they think it works. Oh, they're out there to screw the retail guy. Trust me, they don't care about the retail, right? They'll run over the retail just as much as they'll run over another institutional player. They don't care. They got to, the thing is, they got to get a job done. Market makers got to get a job done. If they can't find the buyers, if they can't find the sellers, or matching up, okay, then they got to move it to areas where somebody is interested. Okay, they got to find that liquidity. It's not, the big difference is this, right? You and I and everybody, probably listening here, we live off the 2 and 3 points and 3 and 5 points and whatever we can make, right? And that's what, these people, again, institutional players, right? As market maker, I didn't care about 10 points, right? I cared about, can I get the liquidity within 10 points, and because I'm going to get an average price with somewhere within that 10-point area, but I need to find out where that liquidity is, right? And that's what really matters the most to big institutional players, be it, futures contracts is really a derivative, right? So it's a lot of hedging, goes along with futures, right? In just bona fide market making, I did a lot of hedging with positions with futures. I wasn't speculating on futures. I was using them as a hedge, right? As a market maker. But really what it all comes down to is the cash market. Where can they find liquidity for all these hundreds and millions of shares that need to move around, right? And so it's all about, getting liquidity. All right. And so in doing so, they're not thinking about, I'm gonna, do they have these stop runs and everything else? Sure, it happens, because they all know that. I will say that, years ago when I was market maker, a lot of times, we're just going to go push the highs or push the lows and grab what we can grab. We didn't call it look below or peekaboo or anything. We just said, hey, just going to go smash the bid, see what's out there, see what we can shake up. They're just looking to shake up the tree a lot, right? And so, some people will get stopped out and they'll say, oh, see, the institutions got me. They didn't get you. They're not out to get you. You just happen to have your stop where, maybe you shouldn't have. Yeah, maybe you shouldn't have had your stop there, but they and that's the thing, that they'll blame the market makers, that they're out to get the retail. But, well, if you keep putting your stop where that they're going to go, well, don't put your stop there, right? But, because again, it's, traders are creatures of habit, and that's the whole point, right? They're going to do the same thing over and over again, regardless of how much they get tagged over they're going to do the same thing. Oh, I got it high, I'm going to put a stop 3 ticks above the high, or 4 ticks above the high, or whatever, right? Well, why don't you put it 4 points above the high? That's why, we have a tool here. Again, it's a tool. Let me just get to it quickly and I got to head out here in a few minutes. What am I looking at? Where do I want to go? Oh, I want to go here, right? So we have what's called the D-level money box, right? And again, it's on our website, but D-level money box, and you'll see the notations here, right? D-level, right? And then money box levels, okay? A lot of times what you'll find, and again, let's take a look at this area right here where I'm circling. So that's a D level, okay? And basically what a D level is, it's a small extension above the prior high. Okay, here's the prior high. It's usually a certain distance, okay? And a lot of times and again, we talked about this earlier, when they pop above the prior high or a prior low, okay, a lot of times what will happen is it will go to the D level, okay, and reverse, right? So this is where your kind of peekaboo level would be, right? And again, I learned this years ago in the 80s, right? I worked for a market maker, and again, this is kind of a special level for us, and you can learn more about it. It's on our website, but not to go into details of that. But basically, when I was a young kid in the business, I worked for a market maker, and I basically did all his measurements on everything. And so what he would end up doing, he would fade this, right? He would fade this D level area, not just necessarily the price itself, but that's just the reference. But there's always a zone around this level, right? So he would fade this area. So buyers would be pushing up, pushing up, pushing up, and he'd be shorting them into the buyers. Okay. And then ultimately, high percentage of the time the market would reverse, right? But what was really happening here? Well, you had this prior high right here, okay? And then a lot of times what would happen, these are all buy stops in this vicinity, all right? So guess what? All this push above the high, right, was just triggering off buy stops. And it would take a little bit of time, not necessarily, this is a 60-minute, but it would take a little bit of time to, feed through, right? Sometimes it's quicker than others. But the point is, right, you would get these buy stop runs, right? And then eventually, if it was a true breakout, it would continue. But if it didn't, most of the time it didn't, right? It would fade back in. So, this guy would be short, into this D level zone, and basically he's filling the buyers, filling the shorts. Filling the buy stops rather. Okay, and so and again, you could do this all day long, right? With and this is a daily one, right? Off the daily, but you could do it all day long with individual price moves, right? They're all over the place, right? It's a little bit harder on so here, just give you an idea, right? So let's just take this swing right here, right? This swing right here, and then extend it up, right? So what we have this set up here on our tools, okay? So if I took this measurement from high to low, right into, right? So this high to low right here, well, look where it's stopping, right? D level money box right there. Okay, and guess what? Yeah, and guess what happens? It reverses back. So what happened here? What happened here? Well, there's buy stops, right? You know it, right? But this, we're not on a major, again, this is this is 750 tick chart. So even on these swings, right? It extended above this high. Well, they stopped at this high and then it pulled back. So that, whoever was shorting them up into this area, okay, they got buy stops above this level, right? So once they got this pullback and they moved it back higher, the odds of them taking out that high were pretty high. And then the question becomes, well, how high are they gonna, how high potentially could they move it? They can do it wherever they want. But the idea would be, all right, if it's just a stop run, they're going to usually get it to the D level money box area, stall them all out, and then they're going to reverse it. And this happens all the time throughout the entire day, just constantly. All right. And, so the D level money box, this is what I call the dynamic D level MB, DLMB, D level money box. And, and all you really need to do, the simplicity of this, right, is you can just, it's all over the place, but for instance, right, here, I'll just do another one, and then we'll call it a morning here. But so here it is. You take, so this low right here to this high. All right. So again, what I'm measuring is this swing here. Okay. Well, guess where it stopped? We're pretty darn close to it, right? Let me just zoom in here. Oh, wait a minute, let me move back. Okay, there you go. Right? Look where it stopped and reversed. Right? D level money box. That's the low. This is, and again, I can see them readily, right? But and again, this is not an anomaly. This is not something, oh, I'm just cherry picking here. I'm not cherry picking. You could see this over and over and over again. All right. Yeah. but here's what you want to do, right? So this is what I was talking about. Like, you could put a paintbrush in somebody's hand and you're going to get two different paintings, right? So the same thing, I could put this tool. Everybody of that, our membership have access to this tool, and it's a simple tool. It's just a retracement tool, right? But the idea would be is, well, how do you use it? Well, this is kind of what we teach, right? But the idea would be, you just learn how to measure out a swing. Okay, and then you can do this in advance. Here's the rub. Before price ever gets down here, you can put this measurement where you already know where this D-level money box levels are. So as prices are coming down, you're anticipating what? You're anticipating price to come down below this pivot low, enter into that D-level money box zone, right? Now you're looking for, is it a breakdown or is it a stop run, right? That's always the question. Well, it could be a breakdown. Yeah, majority of the time it's going to be a stop run first, right? Because if they ultimately break this down, right, what they'll do is they'll stop run, bring it back up, and then they'll drop it down. Okay, so the play here becomes very, very straightforward, right? If they break this low, what is the D-level money box area that I want to be identifying? And you could sit there and put a buy order, okay, if you want to do a limit buy order type of thing. You could put a buy order there. And again, this is what my one of my early mentors, right, did all the time, right, when I was a young kid in the business. He would be having me measure out where the D-level money box areas would be. Okay, and by the way, we have tools to just do this on the screen. I had to do this all by hand back in the early 80s. Okay, when I got out, when I first got out of school and everything, right? And I mean, I had to do this on I had a freaking calculator and I had a sheet. I had an old spreadsheet, and I was jotting these things down. So here we have the luxury of just doing a quick tool that will do it for us. But in any event, as long as he knew whatever the price was, where that D-level money box area would be, all right, when prices got there, he'd stand there and buy them or sell them, right? And then, because and he had a decent amount of capital to work with. But the point is, right, majority of the time they were just stop runs, right? And again, you can think about this as kind of this, dynamic peekaboo, right? Below this level, jam down, and then reclaim back above, right? It's basically a peekaboo, right? But what we're doing instead, maybe you're buying them on the reclaim level, right? Maybe you're buying them there. What we would be doing, right, and we could do this today, and we do this today as part of somebody's trade plan, is particularly just on the not a true breakout trend. You don't want to. You got to determine kind of what the rhythm is. But if the rhythm is just more kind of rotational, right, these D-level money boxes are typically, they're just going to take out highs, take out lows, grab the stops, reverse it, most of the time reverse them back. You can usually get a pretty good play from these levels. And then, again, the question becomes, well, where would your stop be? Again, you could determine that, but typically, below the final level here. And again, what you have to determine is, well, what the distance is there and what your position size would be. Okay, so all that stuff you have to figure out for yourself. But the structure of it is pretty straightforward. Takes out a low, goes into the D-level money box area, all right? And what we're looking for, the play is we're looking for a reversal. So you could buy this, you could buy it into this level and then maybe add, right? Maybe you do an add on the reclaim, and then you have your scale outs already pre-positioned, right, to scale out. This happens all day long, intraday, not just at the, most people do look above, look below fails for the major highs and lows of every day, which is fine, but these things occur all day long, right? So if you're looking for, people looking for plays, right? You can just kind of, you can just find them, all right? We could do, You can take any swing, right? So I can take this swing here, right? Well, I'm not even going to draw it out. You see what happens, what happened right there. If I were to draw that out, right, let's just do it for argument's sake, right? We already got it set up, right? So take this high to low. There you go, right? I mean, right into the D level. So a lot of this stuff you can be prepared well in advance before it ever happens, that if it happens, I'm going to be prepared, right? So what does that mean? That just means that you need to be forward looking and saying, well, what if this happens? Where could price go, right? And again, this is what I was talking about earlier about, this is like an instrument. You have to trust that prices, if it gets to a certain area, I'm going to take a trade there. All right. I don't know if it'll work, but I'm going to take a trade there, and I'm going to, whatever risk you're going to put on and where your stop would be, you can determine all that in advance, by the way, before it even gets there, right? Because you can say, well, here, my level is whatever 40s, call it. Oops, sorry. My level is, say, 40s, right in here. Okay, and I'm going to put a stop, say, at 32s or something, right? So you get 8 points, right? That may be, you may say, well, shit, 8 points. Well, again, I'm talking minis, but maybe you decide to play micros, right? So maybe you do half a micro. I mean, half a mini, right? So 5 micros or something, or whatever. I mean, there's ways of managing. If 8 points on a mini is too much, or 10 points on a mini is too much, maybe you do half a mini, right? You do 5 micros or something like that. Whatever you do, you do it where it's within your risk parameters, right? And it's not about how much nominal money you make, but it's the same percentage move. So if I buy them here and I sell them, here, whether it's minis or micros, it's the same percentage, right? Return. It's just nominally that it's different. It's the same percentage. So go for the percentage, not the nominal, because the nominal will add up, the more you do them. And as long as you're staying within your certain risk parameter, so that's something that, again, is a very, I've had this around this. Again, I learned this in the 80s. And that's why, again, I just call it the D-level money box zone. And I've been trading this forever, but it does take, the requirement here is it's not automated, and you got to be taking measurements. Like, and the way, which swing do I use? Well, I swing, I mean, you start, once you start working with this, you start using it, you start learning, you'll start seeing them, and you get better and better at them and anticipating what the levels, could be. So that's a tool that, again, it's like having that paintbrush, and it's just how to use it, and this is kind of all the stuff that we kind of go over. People are always looking for trades, and yes, we want to stay in alignment, for the most part, we want to stay in alignment. But at the same time, so like we could do something like this. So they take this high to low. So this would be something right here. Okay, so the most recent high to low swing. Now, it didn't quite hit the D level yet, 23.75, but it's there in advance, right? So, if the market pushes up there, of course, it's the high, right, area as well, right? Maybe we get, some sort of a pullback there, right? Or if it moves up to the money box, maybe we get a pullback from there. Those are still all viable levels to get get reactions from. Okay, but again, knowing you have this swing, the most recent swing, so now you can measure off. If it took out this low, where's the D level? Right, it's right down here at the, what is it, 05s? Yeah, so 05s, which, by the way, is by a key pivot, right, that we mentioned earlier, the 04s. So when you start doing this, you start, like mapping it out in advance of a potential move above or below, a swing high or swing low, and then you're playing it. Now, in the meantime, you have your retracement levels here, by the way, right? 50%, 62%, right? So if again, you could be playing a number of different ways. Hey, maybe I want to buy a 50% retracement, and then looking for a pivot back up. Okay, well, you can map that out. So basically, you're just mapping out the 50% of the swing, because anything else before this is really irrelevant. And that's why I'm saying, like, this is your dynamic sandbox would be, and then maybe hey, 50% retracement. Maybe you think it's we're gonna go up and push the highs again. All right, I want to buy a 50% retracement and with a tight stop below there. So there's so many different ways to play these things. But anyway, yeah, I mean, D-level money box areas, I'm always kind of thinking about reversals from those areas. That's kind of like the primary. It's just like a dynamic, look above, look below play. And it doesn't have, you don't have to get 10, 15 handles out of these things all the time. I mean, you can get 3, 4, 5 handles in many cases pretty consistently. I mean, and again, they add. Yeah, well, that's it. I always said one last thing, and I'm going to run, but I always said, like, if you were running a retail store, right? And my wife talks about this all the time when we go to these little tchotchke type stores. She'll like, if we were running a retail store, you never want a customer to come in and walk out empty-handed. Never. All right. And it doesn't matter that they buy the most expensive. They can buy just little trinket things, whatever, in the store, right? And one of these specialty stores and all that they have in these malls and things like that. And you really don't want somebody to walk out. So you always need to have something, whether it's up front or near the entrance or the exit, right, for that matter. And that's something that's really not expensive. And they say, oh, isn't this nice? Okay, this is $7. Okay, I'll buy this. These little $7, $8 type of things. $3, whatever. Whatever it is. It's like what Manny just said. That helps keeps the lights on. And so, not saying we're scalping on everything, but you take these trades and you say, oh man, 3 points for $150. I'll take $150 all day long. It helps pay a bill. And 3 points. Yeah, well, 3 points here, 3 points there. And all of a sudden, I'm up 18 points. Oh, wow. Okay. And you don't have to take excessive risk in order to get there, 1 or 2 contracts, one for that matter, and and again, it's all how you approach it, little by little. And, you don't have to, the fallacy in this that I find is people feel as though they have to trade big in order to make a lot of money. They don't. Yeah. I mean, as long as there's good movement, which there is in most cases, most days there is, then that's really all it matters. I just want movement. Once we get the movement, then whether it's one contract or two, you don't need 20, but it adds up. So consistency, that's all. Anyways, I'm going to be heading out. I got a meeting here at 12:30. So that's it for me, folks. All right. So yeah, thanks, Manny. It's good conversation today. And yeah. Well, everything worked out pretty well. I mean, everything stayed stable. So again, reach out and thank you, Marlon, on all of that to keep we're up and running stable with the audio and visuals. So Marlon's been doing a great job with it. I'll leave my charts up for now. Again, on just a final review, the opening range trifecta, all as you can see here, are all working out. We get a second scale now on the crude oil, which now I'll move my stop up to the target 1 level, and then trailing on the ES. NQ's already complete on that, so we'll keep that chart going, and we'll keep the main room here going as well. We're long on this pullback into this 50% point. See if we can get a move in during lunchtime. And so everybody sees what we're doing live, be it automated or manual, but you see what's happening here, and again, full transparency and real good conversation. So hope everybody's kind of picking up what we're putting down, as they say. All right, you too, Manny. All right, guys, we'll talk to you soon. Thanks.